You know what breaks my heart more than anything else in this business? It's watching people over 50 make investment mistakes that destroy decades of careful wealth accumulation just when they need that money. Most after running JP Chase for over 20 years and managing wealth for millions of clients approaching or in retirement. I've seen the same devastating pattern repeat over and over. Smart, successful people who built substantial wealth during their working years lose a significant portion of it in their 50s and 60s because they invested in assets that were completely inappropriate for their age and circumstances. At JP Chase, we manage over $4 trillion in assets, including retirement accounts, pension funds, and personal wealth for people across every age group and income level. We see the data on what works and what doesn't work for investors at different life stages, and the data is crystal clear. The investment strategies that can build wealth for people in their 20s, 30s, and 40s can destroy wealth for people in their 50s and beyond. The fundamental problem is that most investors don't adjust their strategies as they age. They continue investing like they're 35 years old when they're actually 55 years old. And that's a recipe for disaster. When you're 35, you have 30 years to recover from investment mistakes. When you're 55, you have 10 years or less before you need to start withdrawing money for retirement. That completely changes the risk-return calculation and should completely change your investment approach. But instead of becoming more conservative, many investors over 50 become more aggressive. They realize they haven't saved enough for retirement. They see younger investors making money in speculative investments, and they try to catch up by taking bigger risks. This is exactly backwards and leads to catastrophic losses that can't be recovered in the limited time they have left before retirement. Today, I want to warn you about 5 specific categories of investments that you absolutely must avoid if you're over 50. These aren't just poor investment choices, they're wealth destroyers that can undo decades of careful savings and leave you facing retirement with a fraction of the wealth you thought you had. Every single one of these investment categories has cost our older clients substantial amounts of money over the past several years, and I don't want to see you make the same mistakes. First investment you must avoid if you're over 50 is speculative growth stocks and meme stocks. I'm talking about companies with no profits, unproven business models, or stock prices that are driven entirely by social media hype and momentum rather than fundamental value. Tesla at $1,200 per share, GameStop during the meme stock craze, any number of electric vehicle startups with no revenue, cryptocurrency-related stocks, and speculative biotechnology companies with no approved products. The problem with speculative growth stocks isn't that they never go up. Sometimes they go up dramatically. The problem is that they're incredibly volatile and can lose 50%, 70%, or even 90% of their value very quickly. And when you're over 50, you don't have time to wait for them to recover, assuming they ever do. At JP Chase, we track the performance of clients who invested heavily in speculative growth stocks during 2020 and 2021. Many of these clients saw their portfolios increase substantially during the pandemic bubble. But those who didn't take profits and who continued holding these speculative positions lost most or all their gains when the bubble burst in 2022. Clients in their 30s and 40s could afford to ride out the volatility, but clients in their 50s and 60s who needed that money for retirement were devastated. Let me give you a specific example. Tesla stock went from around $200 per share in early 2020 to over $1,200 per share by late 2021, then fell back to around $150 per share by late 2022. An investor who bought T200 and sold at $1,200 made 6 times their money. But an investor who bought at $800 and held through the decline lost more than 80% of their investment. The clients who got hurt the worst were those who bought Tesla and other speculative stocks with money they needed for retirement, thinking they were being smart by investing in the future. Instead, they lost money they couldn't afford to lose and had no time to recover. Speculative growth stocks belong in the portfolios of young investors who have decades to ride out volatility and who can afford to lose money without compromising their financial security. If you're over 50, you need investments that preserve capital while generating reasonable returns, not investments that could double your money or cut it in half. The second investment to avoid is cryptocurrency, especially the more speculative and volatile cryptocurrencies beyond Bitcoin and Ethereum. I'm not completely opposed to cryptocurrency. We actually offer Bitcoin exposure through regulated products for clients who want it. But cryptocurrency should never represent more than a tiny portion of an older investor's portfolio, and it should never involve money you need for retirement. The fundamental problem with cryptocurrency for older investors is volatility combined with lack of income generation. Bitcoin has lost more than 75% of its value multiple times in its history. Even during normal periods, it's not unusual for Bitcoin to fluctuate 20 or 30 in a single week. For someone over 50, you might need to access their investments within the next 10, 15 years. This level of volatility is simply inappropriate. At JP Chase, we've seen too many clients over 50 put substantial portions of their retirement savings into cryptocurrency during the 2021 boom, only to watch those investments lose 60 to 80% of their value during 2022. Some of these clients had bought Bitcoin at 60,000 thinking it was going to 100,000 and ended up watching it fall to 15,000. The clients who got hurt the worst were those who bought alternative cryptocurrencies, altcoins that promised even bigger returns in Bitcoin. Many of these altcoins lost 90% or more of their value and may never recover. Clients who put retirement money into these speculative cryptocurrencies suffer devastating losses that they can't afford at their age. If you're over 50 and you want cryptocurrency exposure, limit it to 1 to 2% of your total portfolio. Stick to Bitcoin or Ethereum through regulated investment products and never use money you need for retirement. Treat cryptocurrency like you would treat a lottery ticket. It's fine to risk a small amount for the potential of outsized returns, but never risk money you can't afford to lose. The third investment to avoid is long-term illiquid investments, particularly private equity, hedge funds, and other alternative investments that lock up your money for years at a time. While these investments can be appropriate for younger investors or for wealthy investors who have substantial liquid assets, they're often inappropriate for people over 50 who may need access to their money sooner than expected. The fundamental problem is liquidity risk combined with life stage risk. When you're over 50, the probability increases significantly that you'll face unexpected expenses or situations where you need access to your investments, health issues, job loss, family emergencies, early retirement opportunities, or simply the need to start withdrawing money earlier than originally planned. At JP Chase, we offer private market investments to qualified clients, but we're very careful about recommending them to clients over 50 unless they have substantial other liquid assets. We've seen too many cases where clients needed access to money that was locked up in private equity or hedge fund investments that couldn't be liquidated without substantial penalties or losses. Let me give you an example. During the 2008 financial crisis, why investors needed access to their investments either because they lost their jobs or because they wanted to take advantage of opportunities in public markets. But clients who had substantial allocations to private equity or hedge funds couldn't access that money and missed opportunities or faced financial stress because their money was locked up. The same thing happened during the 2020 pandemic. Clients who had invested in private real estate funds or private equity funds often couldn't access their money even when they faced emergency expenses or wanted to take advantage of opportunities in public markets. If you're over 50, you should strongly favor liquid investments that you can access quickly without penalties. This means focusing on publicly traded stocks, bonds, mutual funds, and ETFs rather than private market investments that lock up your money for years. The fourth investment to avoid is complex financial products with high fees, particularly structured products, variable annuities, and actively managed funds with expense ratios above 1. These products often sound attractive because they promise higher returns or downside protection, but the fees and complexity usually overwhelm any potential benefits, especially for older investors who need to preserve capital. Variable annuities are particularly problematic because they combine high fees with complexity and restrictions that make them inappropriate for most investors over 50. These products often have expense ratios of 2 to 3 annually, plus surrender charges if you need to access your money early, plus restrictions on how you can invest the money within the annuity. At JP Chase, we've analyzed the long-term performance of variable annuities compared to simple, low-cost index fund portfolios. And the index funds almost always outperform after accounting for fees. A client who invests $500,000 in a variable annuity charging 2.5% annually will pay $12,500 per year in fees or $125,000 over 10 years. That same client could achieve similar, better results with index funds charging 0.1% annually, paying only $5,000 over 10 years in fees. The fee difference compounds over time and can reduce your final wealth by hundreds of thousands of dollars when you're over 50 and have limited time to recover from poor investment performance. Every dollar of fees matters enormously. Structured products are even worse because they combine high fees with complexity that most investors don't understand. And with credit risk tied to the issuing financial institution, these products often promise to provide market upside with downside protection, but the terms are usually structured to benefit the issuing bank more than the investor. If you're over 50, stick with simple, low-cost investment products that you understand completely. Index funds, ETFs, individual stocks and bonds, and traditional fixed annuities are usually much better choices than complex products with high fees and restrictions. The fifth and final investment to avoid is leveraged or margin investments where you're borrowing money to invest. This includes buying stocks on margin. Leverage ETFs that use derivatives to amplify returns and any investment strategy that involves borrowing against your home or other assets to invest in the stock market. Leverage amplifies both gains and losses, which makes it inappropriate for older investors who can't afford significant losses. When you're 35 years old and you lose money on a leveraged investment, you have time to earn more money and rebuild your wealth. When you're 55 years old and facing retirement in 10 years, leveraged losses can be catastrophic. At JP Chase, we saw devastating examples of this during the 2008 financial crisis and again during the 2020 pandemic crash. Clients who had borrowed against their homes to invest in the stock market or who had bought stocks on margin faced margin calls and forced selling at exactly the wrong time. Many of these clients not only lost their investment profits, but also ended up owing money to their brokers or facing foreclosure on their homes. Let me give you a specific example. In 2007, many clients borrowed against their homes through home equity lines of credit to invest in the stock market, thinking it was a safe way to use their home equity to build wealth. When the market crashed in 2008, these clients faced a double loss. Their stock investments fell in value while they still owed money on their home equity line. Some clients lost their homes because they couldn't make payments on loans they had taken to make investments that had become worthless. Leveraged ETFs are particularly dangerous because they're designed to amplify daily price movements, which means they can lose substantial value even when the underlying market performs well over time. These products are designed for short-term trading, not long-term investing, but many older investors buy them thinking they're getting better exposure to market growth. If you're over 50, never borrow money to invest. Never use margin to amplify your stock positions. And avoid leverage ETFs completely. Your investment strategy should be based on money you actually have, not on borrowed money that amplifies your risk. Now, let me explain why these 5 categories of investments are particularly dangerous for people over 50 and what you should be doing instead. The fundamental issue is time horizon and risk capacity. When you're young, you have decades to recover from investment mistakes, ride out market volatility, and benefit from compound growth. When you're over 50, you have much less time before you need to start withdrawing money from your investments, which means you can't afford the same level of risk. Additionally, your earning capacity typically peaks in your 40s and 50s, which means you have limited ability to replace investment losses through additional savings. If you lose $200,000 in a speculative investment when you're 35, you might be able to replace that money through increased savings over the next 20 years. If you lose $200,000 when you're 55, you probably can't replace it before retirement. Your investment strategy after 50 should focus on capital preservation with reasonable growth rather than wealth accumulation through high-risk strategies. This means emphasizing investments that have lower volatility, generate income, provide liquidity, and have reasonable fees. At JP Chase, we typically recommend that clients over 50% focus their portfolios on high-quality dividend-paying stocks, investment-grade bonds, Treasury inflation-protected securities, TIPS, low-cost index funds, and real estate investment trust REITs. These investments provide the combination of growth potential, income generation, and capital preservation that's appropriate for investors approaching retirement. The specific allocation depends on your individual circumstances, risk tolerance, and retirement timeline. But a typical portfolio for someone over 50 might be 40 to 60 stocks, focusing on dividend-paying companies and broad market index funds, 30 to 50 bonds, focusing on high-quality corporate and government bonds, and 5 to 10 alternatives like REITs or commodities. This type of portfolio won't generate the exciting returns that you might see from speculative growth stocks or cryptocurrency during bull markets, but it will provide steady growth with much lower risk of catastrophic losses that could derail your retirement plans. The key is to understand that successful investing after 50% isn't about maximizing returns. It's about optimizing the balance between growth and risk to ensure that you have the money you need when you need it. The investments I've warned you about today might be appropriate for younger investors who can afford higher risk in pursuit of higher returns, but they're completely inappropriate for investors over 50% who need to prioritize capital preservation and income genera. If you recognize yourself in any of the investment mistakes I've described today, don't panic, but do take action to rebalance your portfolio toward more age-appropriate investments. Every day you continue holding inappropriate investments is another day you're risking money you can't afford to lose. At JP Chase, we help clients over 50 transition their portfolios from wealth accumulation strategies to wealth preservation strategies. It's not about being conservative for the sake of being conservative. It's about being smart about risk management when you can't afford to be wrong. The difference between a comfortable retirement and a struggling retirement often comes down to the investment decisions you make in your 50s. Make sure those decisions prioritize the preservation of what you've already built, rather than the pursuit of speculative gains that could disappear when you need the most.